welcome to the CNBC-TV18 Mumbai newsroom. I'm Sonal Bhutra and with me as always is Pavitra Parekh. You're watching Mutual Fund Corner. Well, we have an interesting topic to discuss today, an interesting guest as well. It's all about how do we build a portfolio completely, what kind of asset allocation should we look at in such a macro environment. So much has happened in this month itself. We have spoken about the RBI rate pause, the US Fed pause, and we got the mutual fund data as well today. So let's get going, Pavitra.
Let's get going, and we have our guest in the studio with us. So Bharat, thanks a lot for joining us. And like Sonal was pointing out, there's so much going on in this space. We got the RBI data that came, the RBI pause that came through, the MF data, Fed, inflation, all of that. It can be a little bit intimidating for an investor, right? What you should do at a time like this. We're also pretty much at all-time highs on the market. Yes. So take us through how you would approach both sides, the equities as well as the debt part.
Thanks, Pavitra and Sonal. See, I believe that if you want to really make money and invest, first you should try to look at the trend and not the noise. I think so much of data is like earlier days we never used to have so much data, but nowadays you have so much data. And it's very important first to really just go and see the trend. When I look at data, and yesterday we had a Fed meeting as well, right? And they decided to do pause, but it was a hawkish pause.
Yeah.
So the point is very simple, is that, see, there are two parts to it. Let me look at first Fed, because this was yesterday. They decided to do a pause, but what they are trying to do, they are not telling you that I'm going to rise, or there will be there may be 2 rate hikes, but what he's trying to tell you that, guys, take a pause. Okay, I need to stay elevated for longer. And why do I need to stay higher for longer is because I want the economy to slow down. I want the employment rate. They've decided to cut the employment or unemployment rate to 4.1. So if they're cutting those rates, they want you to stay higher. Similarly, in India, ultimately our inflation is not a problem. See, we next year projected inflation is 5.1. Now, we don't have a problem. 4 to 6 is a comfortable level. But RBI, if you go and see governor, he's talked so hawkish. Why he's talking hawkish? Because he's just trying to tell you, guys, don't get into all this. Focus on this. We need to stay elevated for longer. So inflation is not a concern. Macroeconomic factors is not a concern. And interest rate hike is broadly behind us. That's not the case. If you look at from the equity point of view, see, we are today trading at around 22 trailing 12 months. In a 22 trailing 12 months, we are at fair price. See, you can't say that I'm undervalued or overvalued. See, that excess valuation which we had, 18 months of underperformance, and the fact is that our index is the same level which was 18 months back, has broadly taken care. 33 to 40% growth in our earning has taken care of all that excess valuation. So I'm at fair valuation today. 20-year average is around 21.5. Last 10-year average is around 24. So I'm not expensive from the market point of view. But that doesn't mean that from here I can rally, right? Ultimately, I need to see the earning growth. I need to see. So when we look at our data and what we, do the projection that what kind of the earning growth will be. And at 16.5% earning growth, I will be like 1,080 EPS, 2025. And at 20p, I will be like 21,500, 25,600. Guys will get very excited that, oh, wow, I'm at 21,600. But the fact is just 20 times P. And ultimately, I'm a growth economy. So I need to be done that. So today, when I look at my advice to the clients and the investors is that don't get carried away with the noise. Focus on your asset allocation. Make sure that you don't break your asset allocation just because there's too much of noise. Have your debt and equity allocation right. When it comes to debt, now there's no tax benefit. So I need to be mindful of that while creating the portfolio. As far as equity is concerned, because I'm at a fair price, there is so much of global events happening. There can potentially give me 5-10% downside on any day because of some event. Like yesterday, if he might have been hawkish, but he might have done another hike also. All of a sudden, you might have seen some pain in the market. And you should be prepared. But I really don't want to be in cash 6 months, 8 months down the line. Because election is approaching. All this noise related to, say, US gets settled down. Ultimately, investor will chase growth. And where is the growth? India, some big tech. And otherwise, you'll find it tough. So they will ultimately come. See, they will not coming. May we had a good month, April that some, June is decent enough from FI point of view. But I don't want to be out on cash and waiting for that correction to happen because nobody catches it. I build my portfolio, do an asset allocation, hold tight. There's no reason to be bearish on the market, no reason to just put all your money in. If you're incrementally investing, please stagger it.
Okay. So, you're the fourth expert in last 24 hours saying that the markets are fairly valued. We spoke to BE Parings today in the morning and we spoke Bearing Speed today in the morning. We spoke to Mr. Prashant Jain yesterday. All of them are talking about markets being fairly valued at current levels. So, let's break it down. Since you spoke about don't break your asset allocation, allocate it between debt and equity in a certain manner. Let's start with the large cap category. That saw outflows this time. First of all, what is the reason that you're ascribing to this? And do you think this is something that will continue for coming months as well?
See, Sonal, we do a lot of analysis, right? And we also had the same question. Why it's really happening? Why we really don't see flows in the large cap fund? Why investors are there? And what we did is that we just picked up the data for last 5 years.
Yeah.
And we decided, okay, let me figure it out that if investor might have invested every month in each of these funds, like there are 32 large cap funds, and we did this one. So each fund gets a 500 odd data points, and we did that analysis. What we have really realized on a 3-year holding, only 5 out of 32 funds actually outperform benchmark. And that also 50% of the time. So it means that the guy, only half of the time, only 5 out of 32 outperform. What that means is that there are no more information asymmetries available in the market. Everybody is tracking those 50 stocks. Everybody knows what is happening. And the opportunity to generate alpha in those funds have become very, very limited. At the same time, you see that small cap and mid caps, they performed really well. They've generated alpha. They continue to show you some good quality stocks picking by some of the good fund managers. And the third is your indexes. If I'm not able to generate alpha, why will I pay you the expense ratio? I'll move to a low cost index funds. So if you put all these 3 things together, it's really makes sense. Going forward, I think top 50 is too much covered, right? Every analyst covers those companies in, out, the estimate in terms of their...
There's no fresh idea.
There's no fresh idea. There's no difference between the two analysis. Everybody come out with a similar number, 2% here and there. You really can't generate alpha. So I believe that large cap is the place where you prefer to have it with low cost index fund kind of a strategy and focus towards the small cap and mid cap to generate alpha.
I mean, this is a study we've done as well, Bharat, where large cap fund managers have found it tough to beat the index. But this is, of course, in large part because of the rule as well that you can't have more than a certain amount of exposure to a sector,
right.
Even though on the index, of course, it's not like that. So this is a long-standing debate, of course. But I take your point that, maybe an index fund is a better route to go down. You did mention the mid and small cap space, which has just been crazy. I was looking at the inflows for this month, for last month as well, and it's absolutely through the roof. So tell us, do you think this trend is likely to continue for the rest of the year? Do you see the action in the broader markets? I mean, the mid-cap index in itself is up, 11-12% already this year.
See, Pavitra, when we looked at, you have to understand. So who is the guy who's putting the money? Is the retail investors, right? Where is the SIP coming? You just spoke about the mutual fund data, right?
Yeah.
There's a large chunk of SIPs coming by from those retail investors.
Yeah.
What they really look at? They look at past performance. Unfortunately or fortunately, whatever you call it, that's what they look at. When that guy is looking at the last 3 years, 5-year return, I'm not talking about even 1 year return, say like 3-year and 5-year return, what you will see? When you look at data and if you look at, say, last 5-year data, now in 5-year data, Nifty might is given you a 26% CAGR. Large cap funds have given you a 23% CAGR. Okay. If you look at, say, mid cap fund, they've given you a 32% CAGR, whereas the small cap has given you 43% CAGR. Now, if you see those kind of a number, money will flow there.
Yeah.
You can't help it, right? So that number is there. But now this is not standalone. Even if you look at their earning growth, right? Nifty might have done an 11% earning growth.
Yeah.
Whereas if you look at really the small cap and mid cap, that numbers is in 20s and 30s. Now, you have an earning growth behind you. You have a stock picker fund manager for you. They provide you an alpha generation strategy and you have an outstanding performance. Where will you look? And that's what is really happening, why they are really crazy. But I just put a word of caution.
Yeah.
Again, don't just go and over allocate to these funds. Be mindful, they are not cheap. Okay, and there's a froth. To be very frank, if you go and see the stocks which are flying, I think there is a froth in that particular market. You need to be mindful. 5-year kind of a time horizon, I think still the alpha will get generated in these funds.
Okay, volatility always comes along with this space as well. Bharat, it's a very interesting chat. We'll continue this because we have to get into a short break and we have a lot more questions for you. We'll continue on the other side. Stay tuned for that. Welcome back. You're still with us on Mutual Fund Corner. We still have with us Bharat Pareek, who's the head of products at ICICI Securities Private Wealth Management. We've been having a lot of interesting conversations about a lot of categories. But let me talk about your equity model portfolio. We've spoken about that in your recent note. Take us through that. What is the rationale? And if we look at the thematic funds, you know, we saw the defense fund launched by HDFC right now. We're seeing a lot of thematic funds being launched. But do you think that is a category where an investor should be invested?
See, when we construct a portfolio, we really don't look at, say, thematics and all. Our approach is very simple, right? I need to create my core portfolio on a long period of time. I want to play something, I will play it thematic, which we call a satellite. So we follow a core and satellite approach.
Yeah.
First, there is a core portfolio. And then I try to spice it up with some of these stuff, and which may be temporary, maybe 1 year, 2 year view. But my core portfolio is not something which I change. So, and we spoke about large cap, right? Generating alpha in the large cap. But can I avoid a large cap in my portfolio? The answer is no, right? So what we really do is that we say, okay, let the fund manager decide what kind of allocation he wants to do. How he just want to generate an alpha between large cap, mid cap and small cap. And we use flexi cap as our core portfolio allocation. So 50% of our portfolio allocation in the model portfolio is actually flexi cap. Okay, and there are some particular trends which we get observed. So while selecting a fund manager, like we like a Contra approach, right? It's a contrarian approach. So we have Contra. We actually rided the entire rally in terms of the value approach. So all those guys who used to have a value oriented funds, we have done this. And almost 6-8 months back, we have slowly and gradually moved away from value, and we have moved to growth at reasonable price, because I believe that now the next round of returns will be driven by growth, not by value, because value has already been caught up. So now my entire portfolio in terms of flexi cap is really driven by two factors. Either you are having a contrarian approach or you are having a growth at reasonable price. So that's around 50% of our portfolio. As we spoke, 10% is in index funds. I need to just balance it because I get underweight to large cap if I don't have that. Then we have a 20% to mid cap and small cap. There what we have done is that we have 10% to each of them, because we still believe there's a lot of value there, but I need to be very careful about the guy whom I really give the money. And then another 20% is my core satellite allocation. There, actually, if you look at my portfolio, either I'm doing a contrarian trade or I'm trying to ride on a wave where I believe there's a lot of money. So we've been riding the infrastructure wave for a whole period of time, and there's no reason for me to really drive it down. Now, it gives me two benefits. One, that I'm able to drive multiple sectors through a single fund. So I'm going to take care of my banking, defense, manufacturing, all those things get captured through my infrastructure stuff. On top of that, I have a banking, which I believe is a reasonably priced, and so we are riding that. And this month, as a contrarian trade, we have brought in the tech again. So we believe that tech is really undervalued. I think there's too much of fear. And as Warren Buffett says, buy whenever there's a fear on the street. So we believe there is a fear on the street, and nobody wants to buy tech. Today morning also the report comes and say underweight. I think it's too much. There are reasons why they've underperformed, but I think it's our research overview that yes, that's broadly in the price, and as a tactical play you can take. So that's what our portfolio looks like today.
Okay, very interesting over there, the construction of this portfolio. You briefly mentioned Contra, and I want to get a little bit more into that. You can directly look for an investor just at a Contra fund, right? Especially in a market cycle like this, where there are such divergent trends sort of appearing. Do you think that's a good bet to take at a time like this? And also, who would you say this is well suited to? Because someone taking this kind of bet should have a little bit of idea what he's really getting into as well.
See, if you look at a Contra fund manager, will all the fund managers will perform when the cycle is turning. Okay, because it's a cycle, right? You are trying to capture something, but in a trending market they may not be, and that's why it is important to figure out to whom you are betting money on, right? Ultimately, there are three fund risk in the fund management, right, or money management: macro, micro, and ultimately fund manager. So Contra is actually a fund manager risk. It is the fund manager who decide. You have to figure it out, a guy who has that kind of a contrarian bias. He always look at those kind of things. He's nimble, he's agile, he's making sure that he is able to capture those. See, if you capture something, your timing goes wrong, you may not be able to pick up the cycle, you may pick up a guy or a stock which may not perform for a very long period of time, and you will have it. So we actually believe that contrarian call, if you want to take it, you have to go and bet on a fund manager who is agile in this. And that's why we like contrarian approach. I think law of averages applies a lot of places. This is a one more place, but you need to be mindful, and it comes with a risk, right? It's one of the very high risk strategy, because it ultimately may not perform when the market is really driving. So it's a contrarian, but I think a market like India, there are a lot of things keeps on going up and down, and I think these guys really have that agility to keep moving.
A lot of opportunities available.
Yes.
So that is about the Contra fund or Contra investing. Let's talk about debt funds, because as we were speaking about it earlier, RBI has paused the rates, but it's a hawkish tone. We've spoken about the tax benefit going away, making it tax neutral now. There's no advantage. How do you look at it? Because we've seen flows also changing after that. Is this still a category which you like over, say, a fixed deposit or other categories?
See, we spoke, right? The fact is that RBI has did a hawkish pause, or Fed did a hawkish pause, and ultimately there will be rise. But ultimately, we're close to the peak of the interest rate cycle, right? If you look at the entire curve, which is the short end to the long end, we are broadly 50 basis point from the peak. Yeah, 50 basis point lower. So first, the easy money from that curve is already been made, right? Whoever has really had that contrarian approach and might have bought, they might have made money. But now if you look at today, when my 10-year is closer to 7%, I personally believe that today we are not at a place where I can expect an immediate rate cuts. So it's going to be, higher for longer, and I need to have a patience. But whenever the next round of rally will happen in the debt market, it will be driven by rate cuts. RBI will do rate cuts after Fed, or when he's sure that Fed is cutting. He is not going to do it, preempt and do a rate cut. So you should not go and bank it that he will cut it because his inflation is lower than his targets. So that's what our thing is. And that's why we believe that it's going to be a pause for a prolonged period of time before we see the cut. And ultimately, the rate cut will drive the next round of pricing and the profitability or the money making. And hence, we like 3 to 5 year. It doesn't give me too much of interest rate risk. But when the interest rate fall, I will have a sufficient duration to capitalize on the capital gain also. So we like 3 to 5 year. Now coming to the tax point of view, really tax takes away the entire fun out of the debt. And now what we do for our client is very simple. We tell them that, sir, if you are doing a balanced fund or a balanced portfolio creation or an aggressive portfolio or a growth portfolio, you are actually taking an equity. Why don't you take a fund which have a combination of debt and equity and fill your debt portfolio from that rather than doing an independent debt portfolio? And that is what we have been advising. So if the customer is doing it, we are giving them a multi-asset funds, equity savings funds, now that recent NFO of Edelweiss. So we are giving those funds where tax efficiency are still intact while creating a portfolio. But if somebody is saying, boss, no equity means no equity, and I have no other choice but to give it, I like the 3 to 5 year, and we give them that kind of a portfolio. My model portfolio today, again, we spoke about model portfolio, I have a 5-year duration today, has a good combination of debt, equity, debt, and in that I have a medium term, some dynamic bond funds, and some short term funds also.
That would explain the flows also, right? For example, hybrid funds or massive inflows come through. So that
arbitrage, all those guys.
Yeah. So I mean, I get that money flowing into these categories now. The other thing I want to ask you is that, of course, for any investor, you could have a different category of, what your preference is. Someone might want a growth portfolio. Someone might want a very aggressive kind of approach. Someone might want to take less risk. What is the kind of allocation that you would suggest for all of these different cases? If you can just take us through that.
See, ultimately, it's an asset allocation. Every individual has to decide based on his risk appetite, time horizon, and goals, what kind of portfolio it is. To ballpark, we have all categorized this into 5 categories. See, we follow, so we have a model, right? We don't do it just because I like it or this like it. We have a model, which model will basically tell you that we have a Monte Carlo simulation. And on top of that, we'll use black litterment as a model. And based on the 2 models, we create a efficient front line. And let's not make it so complicated that guys will not understand. So I make it simple. We use all this, figure it out what is the best possible combination at what kind of risk. Based on that risk outcome, we take it out. Now, to simplify for today, we like gold and silver. So all our portfolios have 10% gold and silver. Okay. On top of that, we have taken away some chip out of equity and some chip out of debt to do it. So today, if you look at a growth guy who has a more tilt towards equity than debt, I have a 70% equity, 20% debt, 10%
There's
gold
some
and silver.
mixed up for everyone.
Yeah, and if you're a balanced guy, typically who like to have a 50-50, I'm overweight equity. So we are 52.5% on equity. We have around 17.5% on the debt part, and we have 10% in this. So broadly, I've taken away some chip from, actually I'm overweight equity, overweight on gold and silver, and I've taken away all that money from debt.
Yes. So it depends on what kind of risk profile do you have, and depending on that, and time horizon. So depending on that, from risk averse to conservative to balanced to growth to aggressive, You've put those chips in different baskets in different quantities as well. But it was such a pleasure speaking with you. Thank you for coming down to our studios. It was an interesting explainer in the current macro situation and so much happening, so much noise, as you said, cutting it down and looking at the right allocation as well. Thanks a lot for your expert opinion. And with that, Pavitra, I think it's time to take our viewers' leave on this edition of Mutual Fund Corner. Stay tuned for Closing Bell to take you through the last hour of trade.